Donald Trump was once again at the center of an economic storm. With inflation still stubborn and global markets on edge, the former president is demanding that the Federal Reserve slash interest rates dramatically, far beyond what most economists believe is safe. He insists that rates are far too high and that the Fed is moving too late, arguing that steep cuts are needed to boost housing, create jobs.
I've noticed that there are no ships in the ocean anymore. We're seeing that there's like no ships, when the first...
And ignite growth. But just as Trump ramps up the pressure, another story unfolds that could transform the way money moves around the world. PayPal, one of the largest digital payment platforms, has announced that it will allow users to send Bitcoin, Ethereum, and its own stablecoin directly to friends, family, and even external crypto wallets. In a single week, two headlines, Trump pushing for aggressive rate cuts and PayPal expanding crypto payments, have given investors, policymakers, and everyday savers plenty to think about. Together, they raise a powerful question. Could lower interest rates and mainstream crypto adoption collide to reshape the entire financial system? Trump versus the Federal Reserve. Trump's criticism of the Federal Reserve is nothing new, but the urgency of his latest demands stands out. He has called for rate cuts of a full percentage point, a move that would be unusually aggressive by any standard. In speeches and interviews, he has accused Fed Chair Jerome Powell of holding rates 3 percentage points too high, warning that the central bank is choking growth and hurting the housing market. Major outlets from Investopedia to Reuters and Fox Business report that Trump's pressure campaign is intensifying as the Fed prepares for its next policy meeting. Markets are currently expecting a modest quarter-point reduction, but Trump wants far more. He argues that inflation is easing enough to justify dramatic action, and has even hinted that the Fed is acting too slowly to keep up with the economy's needs. The Fed, however, is signaling caution. Policymakers remain concerned that inflation, while lower than last year, is still above their 2% target. Labor market data shows signs of slowing, but not enough to justify a sweeping policy shift. According to reports, the most likely outcome is a 25 basis point cut, far short of what Trump demands. That difference sets up a political and economic clash, a former president applying heavy public pressure versus a central bank that is supposed to remain independent. Independence under pressure. This tug of war goes beyond mere words. Trump has already attempted to influence the Fed's makeup, moving to replace certain board members and nominating officials who might favor looser monetary policy. One new appointee, Stephen Moran, has said he will make decisions based on data, yet his critics fear he will lean toward political priorities. Economists warn that if investors start believing the Fed is caving to political pressure, confidence in U.S. monetary policy could erode. That could lead to higher long-term borrowing costs for the government, businesses, and consumers, even if the Fed cuts short-term rates. What rapid cuts could mean. Slashing rates quickly may sound like a boon for borrowers, but experts caution it could backfire. Lowering rates aggressively can stir fears of future inflation. If investors believe prices will climb, long-term bond yields rise, pushing mortgage rates and other borrowing costs higher, not lower. The federal government could also face higher interest expenses on its enormous debt if markets lose faith in the Fed's commitment to price stability. Markets currently anticipate a small, measured cut, not a dramatic pivot. A sudden large move could spark volatility in stocks, bonds, and currency markets, while equities might rally at first. On the promise of cheap money, an inflation scare could reverse those gains just as quickly. In short, Trump's preferred policy might deliver short-term excitement, but long-term instability. PayPal's crypto breakthrough. While the political drama unfolds in Washington, PayPal is quietly rewriting the future of everyday payments. The company has introduced a feature called PayPal Links, allowing users to send or request money with a simple personalized link. More striking is its decision to integrate cryptocurrency directly into these peer-to-peer transactions. U.S. users will soon be able to transfer Bitcoin, Ethereum, and PayPal's own stablecoin PYUSD, not just within PayPal, but also across Venmo and compatible external wallets. This is a major step toward mainstream crypto adoption. For years, digital coins were mostly speculative investments. Now, PayPal is positioning them as everyday spending tools. Sending Bitcoin to a friend could soon be as easy as sending an email. Industry watchers note that the platform's massive user base gives this move unprecedented reach, potentially bringing cryptocurrency into the financial habits of millions who have never traded a token. The change also arrives with a measure of practicality. Transfers that count as gifts, reimbursements, or simple bill splitting may avoid certain tax reporting requirements, lowering barriers for casual users. By making crypto transactions simple and familiar, PayPal is reducing the psychological and technical hurdles that have long kept digital currency on the fringe. Two stories, one market. What happens when these two forces, monetary policy shifts and new crypto infrastructure, intersect? Lower interest rates typically mean cheaper borrowing, more liquidity, and a search for higher returns. Investors often respond by moving money into riskier assets, such as stocks and increasingly cryptocurrencies. If the Fed cuts rates even modestly, and if markets believe more cuts are coming, that could create a tailwind for Bitcoin and Ethereum prices. Combine that with PayPal's massive user network, suddenly able to send and receive crypto as easily as dollars, and you have the makings of a powerful catalyst. Cheaper money and easier access could feed each other, drawing new participants into the crypto market and pushing adoption far beyond the current core of enthusiasts. Yet this is far from a guaranteed boom. If the Fed bows too much to political pressure, inflation expectations could surge, sending long-term interest rates higher and creating turbulence that undermines both stock and crypto markets. Even without runaway inflation, a sudden surge in speculative demand could invite regulatory scrutiny, especially if consumer protections lag behind innovation. Possible futures. The most likely near-term scenario is a careful Fed. Analysts expect a 0.25% rate cut at the next meeting, with further moves dependent on inflation data. Trump will continue to call for more. PayPal, meanwhile, will roll out its crypto payment features first in the United States and then internationally. That combination, gradual easing and expanding crypto infrastructure, could steadily support asset prices without igniting runaway inflation. An optimistic outcome would see moderate rate cuts, stimulating growth, while PayPal's crypto integration drives real-world adoption. Bitcoin and Ethereum could gain not just in price, but in everyday utility, moving closer to the mainstream vision that early advocates imagined. The pessimistic view is more chaotic. If inflation unexpectedly rises or investors lose faith in the Fed's independence, long-term yields could spike. Housing and stock markets might wobble, and crypto prices, sensitive to both liquidity and risk appetite, could swing wildly. In that scenario, PayPal's innovation might matter less to prices and more as a test of how well decentralized assets hold up under stress. The big picture. These developments underscore how intertwined politics, monetary policy, and technology have become. A single politician's pressure campaign can rattle global markets. A single company's product launch can push digital currencies closer to everyday use. Each on its own is significant. Together, they hint at a financial world that is faster, more volatile, and more connected than ever. For individuals, the message is clear. Stay informed. Interest rates influence everything from mortgage payments to credit card debt. Crypto adoption could eventually change how you pay friends, shop online, or invest your savings. Whether you see opportunity or risk, these are changes no one can afford to ignore. So where does this leave us? Donald Trump is demanding massive rate cuts that the Federal Reserve is unlikely to deliver in full. The Fed, wary of inflation and eager to protect its independence, is leaning toward a cautious approach. At the same time, PayPal is bringing Bitcoin, Ethereum, and stablecoins into daily transactions, a step that could redefine the way we move money. If these trends converge, cheaper money from the Fed and frictionless crypto payments from PayPal, the financial landscape could shift dramatically. Some see a chance for a new crypto bull run. Others worry about inflation and instability. Both possibilities are real. What do you think? Is this a bullish turning point for cryptocurrency and markets, or a risky path toward inflation and volatility? Share your thoughts in the comments. And if you want clear, timely updates on the intersection of money, politics, and technology, hit that like button, subscribe to the channel, and turn on notifications so you never miss a deep dive like this one.